bought my first property in 2011. Even some of those properties in a 10-year period, they've doubled or tripled in value. So had I not taken the action back then I wouldn't have the results that I've got now.
This property was purchased for $204,000 in 2014. Unremarkable suburb, nothing special, not even espresso coffee. Fast forward to today and it's worth over $800,000, which shows you capital growth is rarely linear.
As property investors, we're not looking in the rear view mirror, we're looking what's going to go forward. And where in 10 years' time, if we're having this conversation, where is going to outperform.
Our guest today is buyer's agent Ross LeCain, and what he's going to show you in this episode is that investment properties rarely look like standout properties at the time.
It's about land scarcity, gentrification timing, rental yield versus capital growth, and knowing which phase of your investing journey you're actually in. Because the right move at phase 1 is totally wrong at phase 3.
In terms of looking at the property, yes, you need to focus on the fundamentals, right? Is this property going to grow over the long period of time?
If you've ever looked at a property and thought, I wouldn't want to live there, this episode is going to change how you look at every property from here on out.
You need to understand as a first-time investor that, hey, I want to be in the market for the long term. Then you've got to say, well, where would you buy a property that's going to grow for the long term?
Before we get into the episode, please be aware that the discussions in this podcast are for informational purposes only and should not be considered financial or legal advice. It does not take into consideration your personal circumstances. Consult a qualified professional first before making any investment decisions.
What's happening lately in the world of buyer's agency, Ross?
The market's interesting. Obviously, there's a lot going on in the economy at the moment. You know, consumer sentiment and business confidence are, I think at all-time lows since COVID. So it's creating a real opportunity for the right people in the property market right now. So, what we're seeing around is markets probably come off by about 5%. Which, and it's turned from being a seller's market into a buyer's market. We're seeing a lot more properties that, would have been going to auction that are now going to private sale. And, where there may have been, say 10 bidders at some of the auctions we're going, now there's only, 3 or 4, 2 or 3 in some cases. So it's shifted in terms of more to a buyer's market. So there's some real opportunities in the market. I mean, the fundamentals haven't changed, which is the most important. Long-term fundamentals, there's just not enough supply in the major centres. We're still seeing vacancy rates, 1.5% in most capital cities around Australia. With this sort of lack of confidence, there's just not the supply coming on, right? I think the government's got the goal of hitting a certain number of properties, and we're well below those targets. And with this latest sort of shock in terms of confidence with what's going on in the market is not going to do anything to do this. And with the things the government's looking at, affecting capital gains tax and so forth. So those things are then going to lessen construction and supply. So it's fascinating. What are you guys finding? You're on the mortgage front. What are you finding that's happening in the market? What's the feedback that your clients are telling you?
Yeah, look, I think we are also hearing a bit of a shift in the sentiment, and not as much confidence going into things, but some of the clients that are in that position really want to use this opportunity to get a good buy. And quite often we're having to work through the psychology with some of these clients that are maybe teetering on the edge. But is that something you have to work with clients on as well?
Definitely. And, it's a constant conversation, almost a daily conversation with our clients at the moment in terms of strip out the noise in terms of what's happening in the market, because it is just that noise. I've been investing in property. I bought my first property in 2011. And, in that time, I've been a mortgage broker for many, many years, as well as, coaching a lot of top mortgage brokers, and now into the buyer's agency business. And, one of the things you get from being in the market for and again, I've been in finance since 2003, of the benefit of, having the last, 25 years in finance and property, you realize that, there's peaks and troughs in the market. But if we strip out the noise in terms of what's happening in the market and we focus on where the opportunities, and uncertainty creates opportunities. Long-term fundamentals are really, really strong, right? Yes, there's going to be some ups and downs, and in this market, there's no different, right? There is going to be those times where again, we've probably seen a 5% fall towards the end of last year to where we are now, but that's just a blip. If we fast forward, 10 or 15 years time, I can guarantee you there's going to be some amazing results. And we're going to look back at this time in the market and think this was an ideal time to buy property. And I think if you look back to, I guess the last upheaval, which was the COVID, right? And, COVID, if you remember back to the start of COVID, there was talks that the market was going to drop by 30, 40%. And at that initial period, there was a lot of uncertainty. And that proved to probably be the best buying opportunity before it really sort of played out and we started to get on and do business as usual, when we realized, hey, the long-term fundamentals are going to stack up for property. And then we saw some of the biggest gains even over the last 5 years where interest rates have increased. There's still been a solid demand for property. And we've seen over the last 5 years, if you look at, what's happened in the last 5 years, you've got markets like, Brisbane has gone up by 100% in the last 5 years. You've got Adelaide that's gone up by 100% in the last 5 years. You've got Perth that's gone up by 100% in the last 5 years. So all these markets in a period of rising interest rates have outperformed. So if average growth over the last 25 years is 7%, these markets, so that would be 35% over a 5-year period. So they've almost tripled the average growth rate over a 5-year period, right? So you look at that and, from what was a period of uncertainty, some people, had they invested, back then, and it's probably, around about 5 years ago now that, we were in COVID, they've tripled their money. So had they listened to the doomsayers, the negativity, and a lot of the things that were around in the market at that point in time, had they sat on the sidelines, they would have lost out, and potentially doubled their money in property in 5 years, which is phenomenal.
Totally. Yeah. And, I remember buying a property in 2022, which was the peak of COVID. And speaking to Manzuru, he said, go buy here in Queensland. Bought it for 400,000. It's now 800,000. And, back then there was fear, the interest rates were high. And, I think in those moments, it's very easy to listen to the media, the fear mongering. And like you said, over the years, we've seen many crises, geopolitical events happen, GFC 2008, .com boom, all these wars going on. I guess someone that's new to investing and they've just jumped in maybe the last couple of years, they're seeing the media, they're seeing things happen. What would you say to them? You said focus on the fundamentals. What should they focus on or look at to make the right objective decision in this opportunity market that we're talking about?
Yeah, and it's a great point, right? So, for a first-time investor, and again, we say there's time in the market or timing the market, right? So, the best time for a first-time investor to invest is when they can afford it, right? And so what does when they can afford it mean, right? So one, they've got to have the savings or they've got to have the deposit to be able to get in the market. You both are in brokers and you're both in finance, so you understand that, right? So they've got to have the deposit or the access to equity to get into the market first, right? They've got to have the cash flow to be able to, hold that property long term. So what things come into the cash flow? So their income comes into the cash flow. the rental return from the property that they purchase comes into the cash flow. But one of the things that not a lot of people take into account as well is the cash flow buffer that allows them to hold the property long term. So just like in business, cash is king. The same for, property investors looking to invest long term, because, short term in property is 5 to 10 years. Medium term is probably 10 to 20, and longer term is 20 years plus, right? And so, and there's a lot of sort of, spruikers and people get out as who, see property as a get rich quick scheme, which is not, right? It's not. It's sort of, it is something that, again, takes time. So you need to understand as a first time investor that, hey, I want to be in the market for the long term. So, the cash flow that we're talking about is important, that we can manage to be able to hold those properties for the long term. So if you've got the deposit, and if you've got the income and you've got the means to hold that property for the long term, then it's a great time to invest as a first time investor. All right.
So yeah, and I think you've seen so many people, you help people buy property at the moment, and so you probably see maybe the two different mindsets as well. You might see someone with huge maybe cash buffer, they got the borrowing, but maybe they're hesitant to get into the market. And then you've seen someone that's scraped together their deposit, but they've just got this mindset that they're trusting the professional advisor and they get into the market. Can you tell us maybe some examples of your clients where you've seen those two examples and one really do really well from that go-to mindset that I need to get into the market as soon as I can?
Yeah, definitely. And if I have a look at some clients, and again, I've got some clients that are in a perfect position at the moment, right? They're in a perfect position. They've got the cash flow buffers, got solid incomes, got good equity in the property, but they're still hesitant, right? And they've been talking about investing and had different conversations, and they've almost got analysis paralysis, right? They're looking and they're taking advice from the wrong people, and they're not taking action, right? And then you've got some others, clients that we've worked with where, and I remember even some really young clients, if I'm going back to my mortgage broking days, that took action, right? So their mum was their property investor. They understood the value of it. They took action, right? They ended up buying a cheaper property out in the west of Sydney back in the time. And, they did it. They used the family guarantee to get into the market. And, within a number of years, both the I think they were boyfriend and girlfriend at the time, but they both bought properties at that point in time. And then they came back to me to do a loan where they were now upgrading and buying their own house using the equity that they'd built up in those first two properties that they'd purchased, right? So whilst they couldn't afford their dream home at that point in time, what it allowed them to do was to get into the market as, a rent investor. And then in a number of years, I was doing finance for, the both of them to buy their first home together, right? Which is a great story about taking action while you can, even though it was a cheaper type sort of property that led them into their next goal, which was that family home, which is amazing to see that. I know in my own investing journey, I look back, as I said, I bought my first property in 2011, and even some of those properties that I look back and in a 10-year period, they've doubled or tripled in value. So had I not taken the action back then I wouldn't have the results that I've got now.
And I know we actually went through this with you personally. We looked at some of your properties and you're like, how is this property going to go up in value? You're like, just look at this property, and you're like, this property has doubled in value. So I think people traditionally think the house needs to be, the best house, everything put together in order for it to grow. And you are a living example of that. You've shown me some of your properties that have doubled in value. What would you say to people that, trying to get it all perfect when it comes to property, that it's not necessarily the case, and what should they focus on?
Yeah. So it's, in terms of looking at the property, yes, you need to focus on the fundamentals, right? Is this property going to grow over the long period of time? And not all properties are created equal, but when we look at properties and look at the properties at the moment in the market, what I tend to focus on in my own portfolio is focusing on, properties that are going to have that long-term growth. So my aim is to not sell, is to hold the properties for the long term. So then you've got to say, well, where would you buy a property that's going to grow for the long term? So then it comes down to the fundamentals that we're talking about. And, most of my properties are held on the eastern seaboard in the major cities or within a commute of the major cities. So we're talking Melbourne, Sydney or Brisbane. All right, why? Because you think if you're going to open a multinational business, where are you going to open one? Right? You're going to open one on the eastern seaboard major city, right? So with that comes employment, right? So employment, again, provides that cash flow that we were talking about to hold the property. So you're going to have population growth, right? Because people are going to move. If you're going to move in from overseas, you're going to go to somewhere that's going to have a job nearby. Right. So we want these fundamentals where there's, more than one industry, that they've got sustainability around industries where the population is going to grow, provide jobs. And, with that, demand is going to become demand for accommodation. Right. So are these properties going to grow in the long term? So, to your point, some of my properties, and an example of a property I bought in the Logan sort of area in Brisbane, and I paid $200,000, for it just over 10 years ago. And it was $200,000, but, I'm getting told that's worth about $800,000 now. So it's almost quadrupled in value. But I'd show you a picture of it and you go, ugh.
No, you did.
Right? Yeah. And it's not the greatest looking property, but the fundamentals were there. So this was a property in Woodridge, right? So if we look at this property back then, I think it was around $204,000 was the purchase price, and it was in around 2014. Right, was when I purchased that property. Back then, it was probably rented for about $350 per week. So the fundamentals, good return back then. We'd love to get a return like that, around 6 or 7% return at that point in time. So, and it had a good land value. I think it's on around about 600 square meters of land. So whilst the property was an average property, the fundamentals were there, right? It was in an area that, there was a scarcity of land. There was, good fundamentals. It was, good transport into Brisbane, down the highway. But it wasn't an area that had gentrified at that period of time. Right? I remember going to the shopping centre, Logan Central Shopping Centre back then, and I couldn't even find an espresso coffee, right? And I'm like, where is this place? But anyway, the fundamentals sort of made sense in terms of that respect. And, one of the things when we talk about that 7% growth on average over the last 25 years, people think the growth is linear. Where if I look at the growth on this property, it was flat, right? So, between 2014 to 2020, there was very little growth, right? Maybe 3% growth, right? And so, but as we said, between 2020 and 2000 today in 2026, that property probably went up from about 300,000 to about 800,000, right? So I guess the lesson in this, had I only held it for a short period of time, maybe 5 years till 2019, I wouldn't have had anywhere near the level of growth. But, since I held for the long period of time, now that property is worth around about $800,000 because of willing to hold for the long period of time. And you probably, similar to me, I had clients that, but through this flat period of growth between sort of 2014 and 2020, saying, hey, this property hasn't performed. And they've actually sold properties. And you probably had clients similar to I did that sold during that time that weren't patient and waited for the level of growth. And, back then when I was looking at Queensland compared to New South Wales and Victoria, I could see the market was undervalued. When I purchased it, you could see the market was undervalued. And I'm seeing that at the moment in places like Melbourne, where, Melbourne used to be at around 90% of the value of Sydney, right? So just 10% under. Whereas at the moment, it's only about 70% of the value of Sydney. So there's significant value in intrinsic value in the Melbourne market at the moment compared to historically where it's been. And so, similar to the level of growth that we're talking about in terms of Brisbane and Perth and so forth, right? Things will come back to their average, right? Things will come back to that 7% average over time. And same for, places like Melbourne, it will come back up. It's only grown 11% in the last 5 years, right? So, in compared to a lot of these other, it's underperformed. But as property investors, we're not looking, in the rear view mirror in terms of we're looking what's going to go forward and where in 10 years time, if we're having this conversation, where is going to outperform, right? And so this is where we, as buyer's agent, yes, we identify those areas that are more likely going to give that long-term results.
Yeah, now, Ross, we hear a lot of first-time investors essentially just probably looking 10 minutes from where they live to buy their investment property, right? And I think in this day and age, it's very, very important to remove the emotion out of these decisions. So can you talk to how important is it to remove your emotion from the decision, and how do you actually go about identifying where a client should buy?
Yeah, definitely. And, most of us understand property, right? Because we've lived in a property all of our lives. So we grow up and we get used to what a property looks like and feels like. And we tend to then, when we go into the investment side, we start to look for a property like we would like to live in, right? Because that's what we know. And, we quite often, want to be able to, touch and feel that property. And it makes sense to go in areas that we're familiar with. But, this is one of the biggest mistakes I see first-time investors do, because, they don't look outside in terms of the market. They just look around where they're looking to live, and they miss the real opportunities for growth. In terms of, if you look at some of those areas and some of those properties where I've purchased properties, I wouldn't live in those properties myself. Right? And I think this was a learning that came on early in my career, is you've got to base it on the fundamentals. Where is their value? Where am I getting the return? Where is going to be the capital growth? Where is going to be the cash flow? Where is likely to outperform the other areas in the market? And where can I get the cash flow so I can hold this property for a longer period of time? And quite often the answer is that's not in your local area. You've got to then look further out, and then you've got to use the services as someone, like ourselves in a buyer's agent, to be able to then go ahead and source the right property for you.
So are you seeing a shift from people wanting to buy their own home to rent vesting just because of where the market is? And do you think that's a good strategy?
Yeah, definitely. And, I think it's a great strategy, especially in this market, because as you said, if you're, say, someone, a Sydney looking to buy your first home and you're going to have to pay for a house, that's going to take a lot of your disposable income. So that's going to take there's not going to be a lot left to then go and invest. Right? So the old rich dad, poor dad philosophy, if I buy my home and it's worth $1 million, when that property goes up in value, the home is going to be worth 2 million. But, so are all the other homes that you're looking to buy going to be worth. So when I've only got one home, is it actually an investment, right? So it's not till I've got my second home over here that's sort of gone up in value, and that's all profit, right? So, when we're looking at people that are looking to rent vest, for the same amount of capital, right? So let's say, for example, what would the repayments be on $1 million loan or a $1.5 million loan?
Say it's a $800K mortgage, paying 6% currently, call it 45, 50 grand at the moment.
All right. So it's about 50,000, or we'll say it's $5,000 per month, right? Is the payment for that particular property, right? So $5,000 per month is the property, and that's in their owner occupied, right? So they've got to live somewhere. So let's say they're living, young people living in a share sort of property, equivalent sort of property, gets a 2 to 3% return. So $1 million property costs them, how much are they going to pay for a room in that with their friends? How much per week?
Probably like 400.
400.
Yeah,
All right.
400,
So say, for example, they've got to have somewhere to live, right? So 1,600, they're not going to have all the other costs, right? But that leaves them around about 3,400 in terms of, so, potentially that 3,400 could be the same amount of cash flow. They could potentially control 3 properties, right? Just purely from a cash flow. So if I can, the same amount that I would spend on a mortgage, control 3 investment properties, and, fast forward 10 years, those 3 investment properties, and even if they were 500,000, cheaper investment properties, and if they've doubled in value, you're now sitting on, a property portfolio worth $3 million. Yes, you continue to invest, but the equity position that you're in here gives you options, right? And so I think, this is definitely becoming a consideration for a lot of people, purely from a financial position, right? We can't, owning your own home gives you so much from an emotional point of view, and sometimes that can't be put into the numbers. But if we're looking purely about wealth creation, rent vesting for young people is definitely the smarter financial decision in terms of to get ahead in this particular market.
Yep. No advice being given right now, by the way.
No,
right.
Exactly. Again, as you say.
And the capital that it takes to actually go into that $1 million being lost going into that property as well, not just the cash flow as well, being tied up into that owner occupied, compared to splitting that, I guess, against 3 investment properties compared to 1.
Exactly. Right. And so you're diversifying your risks. You've got 3 properties potentially in 3 different areas and location. You've got 3 different levels of income, so you've diversified your risk, and potentially, as I said, investing in areas, as we spoke about before, that are going to have a better potential for capital growth and growth fundamentals.
Yeah. Now, Ross, I want to switch gears a little bit, and I really want to take a deep dive into what does a BA look at the moment when trying to identify the actual property that someone should buy? Right, we want to go into the fundamentals. What are you looking at? How are you comparing different properties in that same area?
Yeah, for sure. So there's a number of things that come into it. First of all, if we look, as we've said, you focus on an area that we think is going to outperform. And as I said, Brisbane, Perth, Adelaide have already gone by 100%. So, quite often, people looking, the horse is already bolted. I'm not going to get the same level of growth if I look to invest in that. And again, because we're looking for the long term, we're looking for those areas. So then we can look at, well, what areas have the potential to do something similar over the next 10 to 15 years, because we're looking longer period of time. So once we then come up with an area that we want, and then within those particular cities or locations that we're focusing on. And as I said, I'm not a big fan of regional because I think, COVID has given the regional areas a bit of a boost in terms of, but long term, I think there's some of the areas, again, with what's happening in the economy are at bigger risk to the capitals, right? So I like capital cities or within a commutable distance of a capital city. So then once we've identified the cities or those regional areas outside a major city, then we look at, well, where are the opportunities to get value, right? So in terms of, you understand in terms of if a home is fully renovated, it's already done, it's marketable. Right? Similar to a suburb. Right? If a suburb has all the things, and everything, it's fully gentrified, the price is going to be built in. Right? So when we're looking at suburbs, we're looking at those suburbs where the opportunity for some gentrification to take place, which means it'll accelerate the rate of growth. So let's say, for example, in a simple diagram, and we say, okay, well, we've got a suburb here that's worth $1.5 million, right? And it's already been done, right? It ticks all the boxes with the fundamentals. It's got, all the things that an owner-occupied would dream of. But then you've got a couple of suburbs that are surrounding those suburbs, and maybe they're worth only half of the value, right? Maybe they're only worth $750,000. Right. So for normally what happens when people can't afford here, they look to the next thing, right? So, and then these areas will start to gentrify, right? What I mean by gentrify is, new cafes, new services will move in.
Espresso coffee.
Yeah, espresso coffee will come into it. And, better schools and more infrastructure will come in, which will then change that, right? And, the other things that we're looking at was, well, what investment is being made into these particular areas, right? What are the likely change in development laws or zonings that may come into those particular areas, right? So then we identify those areas that are more likely to gentrify. Then we overlay that with what is the rental demand in those areas. A big thing and especially for areas like Melbourne at the moment, is scarcity of land, right? Scarcity of land is important because, as the cities go and develop, if there's a big opportunity and land, an abundance of land to be developed, it's going to limit the growth of those areas until all of those areas are developed, right? So we're looking for areas that have a scarcity of land. So, they can't just, release a developer and open up another 1,000 homes, right? Which is going to increase the value of those homes more quickly. Same for in terms of the land value, right? We all know that land appreciates in value, and what's the average size block that we're seeing in a new development these days?
It's very small.
It's very small,
Yeah,
right?
yep.
So, by having a bigger land component in the properties that you're buying gives you opportunities. Look at Tasmania at the moment. They've got so much shortage and there's such a rental demand. They've just released a law that allows people to build up to a 90 square meter granny flat, right? If you didn't have that land component in your property, you couldn't take advantage of building a 90 square meter granny flat, right? But if you've got that land opportunity, who knows what the change of zonings? If we look at, to Europe and the size of the blocks and, what's happening over there, land long term is going to be key. So, the land component in a property is really important when it comes down to the individual properties that we're looking at to create value, because whether you want to subdivide, whether you want to add a granny flat, whether you want to redevelop the home and extend, those things will all be decisions that we'll make. As well as, as we said, looking at the planning and the development opportunities that are going on in those particular areas and council areas are really important.
Yeah, I want to go one more layer in, Ross. So, you're identifying suburbs that essentially are probably on the, let's call it the sweet spot of their gentrification journey. Right, so do you go so far as to, what's a good street in that suburb versus a bad street? Three better versus four better? One of the theories I guess I've heard recently was that, the three better might be better bang for buck initially in terms of better yield for how much you're spending. But as that suburb gentrifies and starts to bring in more demographic in a bigger tenant pool, you think about exit, right? And the four better might be more desirable. So over the long term, that might be better value. What's your take on that?
Yeah, definitely. I think, with the particular, per property in the street, it really does come down to street locations, right? Because certain streets may have, say, a higher housing commission demographic, all right, or be further away from transport, or may have a flood overlay to them, or may have single property covenant, which means you can't build. So, coming down to the individual property is important. And then you've got, as you said, the characteristics of the property. So, the thing that drives the market and drives the value is the desire for owner occupiers. So as property investors, we are price takers. The owner occupiers make the prices. And when we look at, the demands, if you look at even from a rental perspective, if you've got a 3-bedroom, 2-bathroom, it's much more desirable for friends to want to share that because they can each have a separate bathroom, right? They don't, everyone fighting to get out the door at 7:30, sharing the one bathroom, right? So even that extra bathroom can make a big difference, not only from the desirability of, a family wanting to own or occupy and live in that, but the livability of that property as a rental property as well. And as you mentioned, in terms of, having that additional bedroom, we've got to look at the way that work and things have changed nowadays, right? So, more often than not, people want that additional room in their house because that's where they're going to be working at 2-3 days a week, or sometimes, they're going to work from home. So no longer is it just the 3 bedrooms is enough. They want additional space so they can have things like a home office, and use that as one of the rooms. So obviously the size of a property moving forward makes a big difference as well to that desirability for the ultimate end buyer, which is potentially going to be an owner occupier.
And how about rental yield? How important is that in your decision when you're looking at properties, or is it irrelevant? Is it more about those other fundamentals?
No, it's definitely important. And as I said, and I've always seen from my point of view, if I can, have, let's say, for example, I've got spare cash of $2,000 per month that I can spend on property. If I can buy one property at negative 2,000, or I can buy 2 properties for the same out of cash flow expense, I'd rather buy 2 properties, right? So what then comes down to that is the ability to hold, and that comes from the cash flow. The biggest cash flow is from the rental yield that we get from the property. So it's balancing, the capital growth that we're going to get for the property with the cash flow. Right. So, and I think, sometimes we may do both, right? As for people building a property, we might pigeon pair them where, one is slightly more negative, and then the next property we buy is slightly a better yield, which sort of balances the cash flow on those particular properties. Or, we have properties where over time we can change the cash flow. I've got a number of, been investing for a long time, as I said, but my next step in my portfolio journey, rather than buying another 5 properties, is to go and put granny flat on it, say 5 of my properties, right? Why? Because that's going to give me another 5 rentals and change the cash flow on those properties. So the ability to change yield in the future is important as well.
And that cash flow, just going back to that, do you have an ideal? I get it asked all the time from clients, how much should I have? How much should I have to hold this property? And what do you kind of say to your clients in terms of, should I have enough cash if I'm losing, 10 grand a year? Should I have 40 grand so I can hold it for the next 4 years? What would you say to clients that are thinking about how much cash do I actually have?
Yeah, I tend, to say 3 to 6 months worth of repayments. Is, as a rule of thumb, if you weren't getting rental from your property, do you have 3 to 6 months worth of repayments to cover those repayments over that period of time, right? Because, in reality is your properties are rarely going to be vacant for that period of time, and they're not all going to be vacant at once. But if we've got that buffer, if things come up, if expenses come up, if you've got that, it's just give you that peace of mind that you can hold the property for the long period of time. But, I think one of the things that's important is there's 3 journeys, right? In terms of, if we look at, the property and we look at the journey in terms of property investing, and I sort of draw this out for clients, quite often, and saying, there's 3 phases when it comes to property investment, right? So we've got the first phase, which is your accumulation phase. Okay, we've got the accumulation phase here, and so this is all around acquiring as many properties as we possibly can, and quite often we come up with a goal. Right, so we come up with a goal, and it might be an income goal or it might be a net asset position. Right, and the aim is to get to that goal as quickly as we possibly can. Right, and so what this quite often means is we will have some negative cash flow, right, in terms of that, because, and again, you guys are mortgage brokers, quite often they're using the equity, so they're borrowing 105% of the property, because they're borrowing all the costs as well. So at this period in their portfolio, they've got some negative cash flow, right? So then, the next phase, and as being in the market for as long as I have, in terms of the last 20 years or so, you get to a point where, once they've built their portfolio, they want to consolidate, right? And so the aim of consolidation is to get to the point where they're making some moves within their portfolio, where they're consolidating, where they're getting to the point through natural growth and through, manufacturing some cash flow, where they're getting to the point where they're getting closer to achieving their goals, but they're balancing their cash flow, right? So, and, what types of things, and I guess you guys see it from your point of view as mortgage brokers, right? What are you seeing where people are balancing their cash flow?
Granny flats.
Granny flats.
Some might even move to commercial.
Some might move to commercial. Some may sell down some properties to pay off some debt. That will then, or sell off some debt to give them some bigger cash flow buffers, right? So they're balancing their cash flow in that consolidation phase. And then if we look at, the final phase is the retirement, right?
On the beach.
Yeah. So So they're on the beach, where this is where we've got the passive income, right? And this is, why people get into property investing in the first place. And again, through the strategies that we've done in the consolidation, whether that's commercial properties, whether that's granny flats, whether that's selling down the portfolio and living off the cash that they've invested in other means, that we get those, that sort of passive income, which is the long-term journey, right? So understanding where clients are at on this journey is very important. Right. And so, during the accumulation phase, I might not spend $200,000 building a granny flat or doing those things, because I want the money that I would have spent that to be the deposit on my next property, because I want to get to my goal. I don't want to focus on doing some of the activities that make sense in a consolidation phase. So I think, one, understanding what the client's goals are, where they are in this phase, is going to make that important. Frank, do you want to sort of talk to this a little bit?
Yeah, just to add to that, Ross. So, some of the things we also see happening during that accumulation phase. So there's quite a lot of equity strips. So someone's loan, like if you look in their bank account, online banking, it's going to look quite messy. You're going to have a lot of little loan splits where they've taken equity to buy the next property. And just to talk to that buffer as well, you did mention like 3 to 6 months, but there's no single answer that is right for everybody, right? So if we look at really what is the purpose of that buffer, it's really to protect that client from becoming what we would call a forced seller, right? So it's not just if the property goes vacant, what if there's some health issues or one of the borrowers can't work for a period of time? How long can you hang on to? Right, that's really what I think someone really needs to think about in terms of what's the right buffer for them. Now, when we move into consolidation, so you mentioned some of the things about this is really optimizing, isn't it? People might be optimizing their loan structures, restructuring for simplicity. So in the accumulation, we had all these little equity releases. We might consolidate them back into the main loans against each property. And then as we go into retirement, now this is where they may actually exit some of those assets, and it's all about maximizing return.
Yeah, I think this is key, Ross, and I think I liked how you've mapped it out here, because I've seen clients that are in accumulation phase maybe do a granny flat too early. And so they've used that fund that it's tied up in construction for 12 months and they could have bought another asset during that time. But I think, a lot of people think, well, how many assets do I need? And I think it's a lot less than people think if they map it out. And so it may only be 5 properties, but I think in that accumulation phase, it's key to focus and not get that shiny object syndrome. I think what I see a lot with our clients is sometimes they get 2 properties, they're like, developing. I want to do developing now, and it's like, well, the goal is to get to 5 properties, and then we can move on to each stage. And I think those stages are key, and it's in stages for a reason. And you've probably seen it many times as well, is that people want to jump to retirement before they even have accumulated.
Exactly.
So I think it's key to follow these steps that Ross has laid out so clearly. Ross, I think it's clear that we can talk a lot about property and your experience, like you said, 2011, since you've first bought your property, and you've given us a lot of wealth, and not to be fearful, especially in this market at the moment. But we're really grateful for you coming on to this episode, and no doubt we'll bring you back on to go even deeper to see what else is happening in the property market at that time. But thank you, Ross.
No worries. Pleasure, guys.